All right, let's get straight to it. The ceasefire is collapsing, and for all intents and purposes, the Strait of Hormuz is closed. On April 8th, the market saw a massive plunge in oil prices, and while a lot of people were celebrating thinking the crisis was over, the reality is that was a mirage. And this is the move that fooled them. You're looking at a huge risk-off reaction to the ceasefire news. A 15% drop in a single day, taking crude well below $95 a barrel. It looked like a massive sigh of relief, right? But the smart money knew this was likely a head fake.
I mean, this quote from Deutsche Bank perfectly sums up the consensus view at the time. Everyone thought an off-ramp had been found, that a devastating energy crisis had just been sidestepped. The relief was absolutely everywhere. But, to really understand why that relief was so misplaced, you have to appreciate the panic that came before it. And that all boils down to one of the most critical choke points in the entire global economy.
20%. That's the number that matters. 1/5 of the entire world's daily oil consumption has to get through this one narrow waterway. So if you control the strait, you have an almost unbelievable amount of leverage on the global markets. It's a massive geopolitical pressure point. And things escalated incredibly fast. I mean, we're talking about a 6-week sprint to the brink. It kicked off in late February with strikes on Iran. By early March, Iran retaliated, basically closing the strait. Markets, of course, went wild. Brent shot past 116. And that all culminated on April 7th with the U.S. issuing a final high-stakes ultimatum. So yeah, that ceasefire announcement felt like it pulled everyone back from the edge. But what we know now is that the celebration was based on a complete misunderstanding of what was actually in the deal. The devil was, as always, in the details. And that's the real question we have to ask. Was this 10-point plan the game changer the market priced in, or was there something critical hiding just below the surface? And here it is. The deal was literally lost in translation. The English version that the West saw was simple enough. Pause the fighting, reopen the strait. But the Farsi version? Well, that had a poison pill, a demand for the acceptance of enrichment for its nuclear program, a total deal-breaker that wasn't being priced in at all. And while the markets were euphoric, the red flags were everywhere if you were paying attention. Iran's Coast Guard was still making direct threats. A critical Saudi pipeline, a key bypass to the Hormuz, got hit by a drone. And the fighting, it never really stopped. Israeli strikes continued in Lebanon. Then came the clarification from Iran. The strait wasn't open, it was under the management of Iran's military. That is not business as usual. Okay, so this whole geopolitical mess didn't just stay in diplomatic channels. It's now creating a massive economic hangover. That initial relief rally is gone, and in its place is a much tougher reality for the global economy. And that reality has a name we all dread: stagflation. You know the playbook: slow growth but sticky high prices. It's the worst-case scenario for central banks, and the fear of it, driven by these persistently high energy costs, is starting to seriously take hold now that the ceasefire's true nature is clear. Which brings us to the big psychological shift in the market. The hope for a V-shaped recovery in oil prices is dead. Now the fear is a higher-for-longer oil regime. The market is slowly waking up to the fact that elevated energy costs are going to be baked into the cake for the foreseeable future, embedding inflation right into the system. So, what's the path forward? Now that we know the ceasefire was a mirage, analysts are basically mapping out 3 distinct scenarios for how this crisis could unfold from here. First up, the bull case. This is your best-case scenario. Diplomacy actually works in Islamabad, a real deal is struck, the strait reopens without conditions, and markets can finally rally as oil prices come down and inflation fears fade. It's the clean resolution. Then you have the bear case, which feels much more probable right now. The talks go nowhere. The higher-for-longer oil price becomes the new normal, and this triggers the stagflation we've been talking about, absolutely crushing consumer stocks and putting a brake on global growth. And finally, the black swan, the tail risk. This is where the conflict escalates dramatically. Imagine a successful strike on critical Saudi infrastructure, say the Ras Tanur refinery. An event like that would freeze global markets instantly and could easily send oil on a trajectory toward $150 a barrel, sparking a deep global recession. So, this so-called ceasefire gave everyone a moment, a pause. But the question you have to be asking yourself is, was it a pause for peace or just a pause before the storm really hits? The answer to that is going to define the next few quarters. All right, that's the breakdown. If you found this useful, do me a favor and hit the like button and subscribe to the channel. And drop a comment below. I want to know your thoughts on how this higher for longer oil regime impacts the AI supercycle. Let's discuss.